Hello students, myself is Parminder Singh from Prab Kripa classes. Our today's topic is unraveling currency fluctuations and in-depth analysis. Nowadays, the value of the currencies does not remain static. The value of the currencies is constantly fluctuating because there is trading in the foreign exchange market. These currency fluctuations affect businesses, consumers, and also international trade. In this course, we will understand the terms like appreciation, currency depreciation, currency revaluation, currency devaluation, and also understand the difference between these concepts. And we will also understand what is their impact on imports, exports, and consumers, etc. You will also understand whether the government of the country also plays any part in the rise and fall of the currency. We will also understand these concepts with the help of real life examples, and by the end of the course you will be in a position to understand the impact of currency movements on businesses, consumers, international trade, and make informed decisions about your international travel. It means that you will be in a position to understand what is the impact of currency appreciation or currency devaluation or currency depreciation, and you can take informed decisions with regard to your exports, your imports, and you can also decide which country you should visit in case of currency fluctuations. So you will find this course very interesting, and that too in a simple language, and you will be in a position to understand all these terms very easily. Thanks for. Now the topic before us is the rise and fall of currencies, understanding currency appreciation and depreciation. Now we will understand the differences between currency appreciation and currency depreciation on various points. First is definition. What is the meaning of currency appreciation? Currency appreciation means increase in the value of domestic currency in relation to other currencies. Suppose we are living in India. Our Indian currency or Indian domestic currency is INR. All the other currencies except Indian rupee, foreign Indian citizen are foreign currencies. Suppose for some time I shift to USA, then my domestic currency will become US dollar. So now at present I am living in India and my domestic currency is Indian rupee and other currency say is US dollar. At present, if I want to purchase one US dollar, I will have to pay approximately 83 Indian rupee to get one US dollar. If there is currency appreciation, what it means? It means that I will have to pay less to get the same amount of other currency. Suppose if I have to pay 80 rupee to get one US dollar, it means that the value of Indian currency or the value of domestic currency has increased or the Indian currency has appreciated. On the other hand, currency depreciation means depreciation in the value of domestic currency relative to other currencies in the foreign exchange market. At present, we have to pay approximately 62 Indian rupee to get one Canadian dollar. We have to pay 62. Suppose if there is currency depreciation, that is the value of our Indian rupee depreciates, then we are taking simply example. We will have to pay more to get the same unit of Canadian dollar. Suppose we have to pay 65 rupee Indian rupee to get the same amount of other currency. If there is currency depreciation, suppose in this example we have assumed that the value of Indian currency has depreciated. That is, we will have to pay the more currency in domestic currency to get the same amount of other currency. Now the second point is impact on imports. In case of currency appreciation, imports become cheaper because the domestic currency has more purchasing power in the foreign markets. We will understand what we have said with the help of an example. Suppose USA company is importing shirts from France. USA company is importing shirts from France. What is the currency of France? Currency of France is euro. What is the currency of USA? It is US dollar. Now we assume that cost of one shirt is equal to 100 euro. We also assume that 1.2 US dollar is equal to 1 euro. So at present, what is the cost of the shirt? At present, the cost of the shirt is 100 euro or 120 US dollar. That is, US company has to pay 120 US dollars to purchase one shirt from France. As they have to pay, will have to pay in euro, they will have to purchase euro, and 100 euro will cost them 120 US dollars. Suppose there is currency appreciation, that is the value of US dollar increases. So after appreciation, we assume 1 US dollar becomes equal to 1 euro after appreciation. That is the value of domestic currency of USA. That is, the US dollar has increased vis-a-vis other currencies. So after appreciation, 1 US dollar has become is equal to 1 euro. Now what is the cost of one shirt after appreciation? The cost of one shirt after appreciation is this, it will remain 100 euro. But in when converted into dollars, what is the present position? Here it is 100 US dollar is now equal to 100 euro. So the cost of shirt at present is 100 US dollar. So earlier the same US company was paying 120 US dollar or 100 euro to import the goods from, to import the shirts from France. Now after the appreciation of the domestic currency of US dollar, the US company is paying the same amount in euro, 100 euro. But as there is appreciation of US dollar, they have to pay less domestic currency. That is, instead of 120 US dollars, the US company is now paying only 100 US dollars to the France. That is, it is only same currency in foreign currency is paying same amount in foreign currency, but in domestic currency they are paying less. So imports have become cheaper for US people when they are importing goods from other country. Now we come to currency depreciation. In the case of currency depreciation, the value of domestic currency decreases. So imports become expensive because the domestic currency has now less purchasing power in the foreign market. Now we assume that cost of one shirt, we are importing, say India is importing shirts from USA. We assume India is importing shirts from USA. The cost of one shirt is $1. At present, the value of 83 Indian rupee. It is 83.51 as on date of recording of this course. 83.51 paisa. We assume that it is approximately equal to 83 Indian rupee is equal to $1. We assume that the cost that when an Indian is importing a shirt from USA, it costs him $1 or the Indian have to pay 83 rupee in Indian currency to import the said shirt. Suppose the value of Indian currency has depreciated. What it means? It means that the Indian people will have to pay more in domestic currencies. We assume that we, after depreciation, we have to pay 87 rupee because 87 rupee has become equal to $1. So after depreciation, we assume that 87 rupee Indian rupee has become equal to $1. So now the cost of one shirt is same $1, but we will have to pay more in Indian currency or more in domestic currency. So imports have become more expensive for the Indians when they are importing goods from USA. Or in other words, we can say that imports become expensive for the people of the resident of the country in which the currency has, in which the domestic currency has depreciated in value. Now the third point is impact on exports. Firstly, we will understand the impact on exports by currency appreciation. What is the impact of currency appreciation on exports? Due to currency appreciation, exports become expensive for foreign buyers. What it means? Swiss franc appreciation is the well-known example of how currency appreciation impacts exports. Swiss franc is the official currency of Switzerland and one small country, Liechtenstein, which is a border state between Switzerland and Austria. Prior to 2015, Swiss National Bank used to adopt a fixed exchange rate between Swiss franc and euro, and approximately the value of 1.2 Swiss franc were equal to 1 euro. This is only approximate figures. Prior to 2015, Swiss National Bank adopted the fixed exchange rate between Swiss franc and euro. In 2015, the Swiss National Bank abandoned the policy of fixed exchange rate of Swiss franc with euro. So due to this amending of the fixed exchange rate which it was following, the value of Swiss franc appreciated by about 20%. That is the value of Swiss franc appreciated vis-a-vis the value of euro. So due to this appreciation of the currency of Switzerland, that is the Swiss franc, the exports from Switzerland became expensive. Switzerland watches, pharmaceuticals, and other products which were exported from Switzerland to other European countries became expensive. So it adversely affected the export-oriented units of Switzerland, and especially those industries which were heavily dependent on the European customers. Now we will come to the impact on exports. What is the impact of currency depreciation on exports? Due to currency depreciation, exports become cheaper for foreign buyers. We take the example. In the late 1990s and early 2000s, Japanese yen depreciated in value vis-a-vis the US dollar and other currencies. That is, the value of Japanese yen has depreciated during this period. Due to this depreciation, the Japanese goods became cheaper for the foreign buyers. As a result of this depreciation of Japanese yen, Japanese companies such as automotive companies such as Honda, Nissan, and electronic companies like Panasonic, Sony were able to sell their products in the international market at cheaper price, and they gained a lot. So the depreciation in the value of domestic currency of Japan helped in increasing the exports. Now we will understand the reasons for currency appreciation and currency depreciation. First, the reason for currency appreciation. In any country, the currency may appreciate due to strong economic fundamentals, that is high GDP growth, low inflation, political stability, increased foreign investment, etc. What it means? If the country is showing good performance, that is, the economic parameters of the country are very good, there is political stability in the country, then what happens? The foreign investors are attracted towards that country. They would like to make investment in a country where there is political stability, which are showing good economic performance. So when the foreign investors come to make investment in a country, the value of the domestic currency of that country appreciates. We take the example of Australia. During early 2000s, Australia witnessed currency appreciation vis-a-vis the other foreign currencies, particularly the US dollars. Why Australia witnessed currency appreciation of their currency? Why the value of Australian dollar appreciated? Why? Because there was high GDP growth. There were robust exports of iron ore and coal. Then booming mining sector. Mining sector was performing very well, and there was stable political environment. So due to all these reasons, GDP growth, good exports, good performance of mining sector, political stability in the country, the value of Australian currency appreciated. On the other hand, the reasons of currency depreciation may be weak economic fundamentals. If a country is not showing good performance for quite a reasonable time, there is low GDP growth, there is high inflation in the country for past many quarters, and the political environment in the country is not stable, the investors from the other countries would not like to make investment in that country. Rather, they would like to pull out their investment from that country and make their investments in some other country. So, in this way, the value of the currency of that country where the economic performance is not good, where political stability is not there, the value of currency of that country depreciates. We take the example of Venezuela. In the late 2010s and even up to in the early 2020s, that is during the late 2010s and even up to early 2020s, Venezuela suffered currency depreciation because there was low GDP growth, high inflation, the policies of the government were not good, there was political instability. All this resulted into the currency depreciation of that country. Even today, the Venezuela has is suffering from currency depreciation and hyperinflation. So from this you have seen that the there are a lot of the reasons for currency appreciation, and there are also many reasons for currency depreciation. If the country's performance is good, the value of the currency appreciates. If the country is not performing well on various counts, then the value of the currency of that country depreciates. Now we will understand the impact of currency appreciation and currency depreciation on tourism. Now we will understand the impact of currency appreciation on tourism. When the value of currency of a country appreciates, then it makes a country more expensive for foreign tourists. What it means? Suppose at present we are living in India. So at present 83 Indian rupee approximately are equal to 1 US dollar. So if a foreigner at present decides to visit India, suppose he has the budget of 1000 US dollars and he is visiting he is visiting India, a US citizen is visiting India, what he will get in return of 1 US thousand at present? He will get 83,000 Indian rupee if he comes to India, and he will spend 83,000 on hotel charges, transportation, food, buying goods, etc. Suppose the value of Indian currency appreciates. What it means? Appreciates. Appreciates means less amount of domestic currency will have to be paid to purchase another currency. Suppose the value of Indian currency has appreciated and now 80 rupee are equal to 1 US dollar. The value of Indian currency has appreciated. Now less amount of domestic currency is equal to the same unit of another currency. Here in this example we have assumed that the value of Indian currency has appreciated. Now the same US citizen, he is now deciding to visit India and he is having the same budget of 1000 US dollars. What he will get after currency appreciation of Indian currency? Indian currency has appreciated, the budget is same 1000 dollars, and now if a US citizen wants to visit India after the appreciation of the currency of India, he will get only 80,000 Indian rupee. That is, in return of the same amount of US dollars, US citizen will have less amount in Indian currency when converted into Indian currency. So, if there is currency appreciation in any country, it reduces inbound tourism. Because the US citizen may think that they may have other options, better options than India. That is, foreigners may think that they have other options where the value of their currency is more. They can visit other countries for travel purpose or for holiday purpose. Now the other impact on tourism is it increases outbound tourism. What it means? We have firstly understood that foreigners are visiting India. Now there are also persons who want to visit from India to other countries. They also want to visit. They also want to have fun, to enjoy life. So earlier, when the value of 83 Indian rupee was equal to 1 US dollar, and we take same example that if the Indian was having 83,000 rupee and he was getting 1000 US dollars. Suppose the same now the Indian wants to visit US. Now with the budget of 83,000 Indian rupee, he was getting 1000 US dollars for spending in USA. Now the value of Indian currency has appreciated. What happens? Now with the same budget, 83,000 Indian rupee, he will be getting more than 1000 US dollars. That is in excess of $1000 he will be getting, or he will have to pay out only 80,000 Indian rupee to get 1000 US dollars after the appreciation of Indian currency. If he decides to spend same amount 83,000, he will get more than 1000 US dollars. But if he decides to spend only 1000 US dollars, he will have to pay less in domestic currency. So currency appreciation reduces inbound tourism and it also increases outbound tourism. It has two effects on tourism. Now we come to the impact of currency depreciation on tourism. Currency depreciation makes a country less expensive for foreign tourists. We understand the same with the help of example. Suppose at present 1 US dollar is equal to 83 Indian rupee. Now suppose the value of Indian currency depreciates. What it means? That after depreciation, if a foreigner visits India, he will get 85. Earlier, if a foreigner visited India, he was getting only 83 rupee in return of 1 US dollar. But as the domestic currency of India, that is the Indian rupee, has depreciated, the same US citizen will now get more currency of Indian rupee for the same amount of US dollars. So it increases inbound tourism as the US or the foreigners will now be in a position to get the more amount of the depreciated currency. It will improve the tourism in that country where the value of currency has depreciated. If the value of Indian currency has depreciated, the tourism will increase, inbound tourism will increase. It also affects the outbound tourism. It reduces outbound tourism. What it means? When the foreigners are visiting a country, the people from our country also would like to make visits to other countries for travel, for fun or other purpose. So earlier, when there was no appreciation or depreciation, the 1 US dollar was equal to 83 Indian rupee. But now, as the value of domestic currency has depreciated, now 1 US dollar is equal to 85 Indian rupee. It means that after currency depreciation, the Indian will have to pay more to get the same amount of other currency. Earlier, if a citizen of India wanted to purchase 100 US dollars, he used to pay 8,300 Indian rupee. But now to get same 100 US dollars, they will have to pay out more, 8,500 Indian rupee. So it reduces outbound tourism because the people may either decide not to go abroad because they may not have the budget which is may be necessary to meet the expenses in the case of depreciation of their domestic currency, because the foreign currency has appreciated, value of foreign currency has appreciated, and the value of domestic currency has depreciated. So currency depreciation increases inbound tourism and it reduces outbound tourism. Now we will understand the impact of currency appreciation and currency depreciation on foreign debt. Firstly, what is the impact of currency appreciation on foreign debt? If the value of a currency of a country appreciates, it makes foreign debt cheaper to repay. What it means? We are living in India. Our currency is Indian rupee. Suppose we take the loan from Canadian government. What is the currency of Canada? It is Canadian dollar. Suppose we take 1 million Canadian dollar loan. That is, the loan has been taken in foreign currency and the currency denomination is Canadian dollar. India government has taken the loan of 1 million Canadian dollar. What is the present value of Canadian dollar? It is somewhat near 62 Indian rupee is equal to 1 Canadian dollar. We are only talking about approximate value to keep the point simpler. It is somewhat more than 62. So what is the loan amount at present which the Indian government has taken? It is 62 million Indian rupee. This is the loan amount, what the loan has been taken. Suppose the value of Indian currency appreciates. What it means? Suppose the value of Indian currency appreciates and now 60 Indian rupee are equal to 1 Canadian dollar. We are simply assuming that the value of domestic currency of India, that is the value of Indian rupee, has appreciated and now 60 rupee are equal to 1 Canadian dollar. So now, what if suppose loan has been taken today and the amount is 62 million dollar, 62 Canadian dollar, 62 million Indian rupee or 1 million Canadian dollar. Now suppose next day or after some days the value of Indian currency has appreciated and it has become equal to 60 Indian rupee equal to 1 Canadian dollar. Now what is the likely amount which the Indian government, if it decides to repay? Now the Indian government after 1 week or 1 month decides that it wants to repay the entire loan. What it will be likely will have to pay when there is currency appreciation of Indian currency? Now the Indian government will have to pay somewhat near 60 million Indian rupee. That is, it will have to pay less in Indian currency. That is, it will require only 60 million Indian rupee. It will convert the same into foreign currency, that is Canadian dollar, and repay the loan. So the currency appreciation is beneficial or positive for the borrowers. Now what is the impact? How much impact currency appreciation has foreign debt? If the amount of loan is very big, then the saving is big. If the loan is small, then the impact is small. If you take $1 billion loan, then you will save in billions. If you take $1 million loan, you will save in millions. Now, what is the impact of currency depreciation on foreign debt? Currency depreciation makes foreign debt more expensive to repay. We understand with the help of an example. Suppose we take, or the Indian government takes loan of say 1 billion US dollar. This is the loan amount which the Indian government has taken from US government. If we convert the same amount in Indian currency today, we are only assuming at present 83.50 83.51 paisa is equal to 1 US dollar. But to keep the point simpler, we assume that 83 Indian rupee are equal to 1 US dollar. So what is the loan amount? If converted into Indian currency, loan amount is approximately equal to 83 billion Indian rupee at present. This is the loan amount. Now, the value of Indian currency has depreciated. It means that we have to pay more to get the same amount of US dollar. Suppose it has depreciated by say 10%. That is, it means that it will roughly come nearby about 91 Indian rupee. We are simply taking approximate figures. If we take the exact value, we assume that it is 80. Here we will take it 80 and here it will become 88. To if we want to understand very clearly, we are here now assuming 80 Indian rupee are equal to 1 US dollar. Loan has been taken 80 billion Indian rupee, and after 10% appreciation, 88 Indian rupee are equal to 1 US dollar. So when the currency has depreciated, and now the government, after the depreciation of the value of Indian currency, the Indian government decides to repay the loan. What amount it will require of domestic currency if he decides to repay? Now the Indian government will require approximately 88 billion rupee, Indian rupee. Earlier it was required only to repay, if it decides so, 80 billion rupee plus interest, but now it will have to pay more in domestic currency. It will buy US dollars of 88 billion Indian rupee and will be in a position to repay the debt. So when there is currency depreciation, it becomes expensive for the country where the currency has depreciated. The foreign debt becomes more expensive to repay. Now we will understand whether central bank of the country intervenes in case of currency appreciation and currency depreciation. Now firstly we will come to currency appreciation. Normally the central bank of the country does not intervene in case of currency appreciation. However, if the currency appreciation is excessive, the central bank may intervene. The central bank may intervene to maintain competitive exchange rate. The central bank may intervene to protect exporters. When the domestic currency of any country appreciates, then exports become expensive for foreign buyers. It adversely affects the exports of the country where the currency has appreciated. It adversely affects the export oriented units and also the job losses in that country where the currency has appreciated. So, to counter this, the central bank may sell their domestic currency to reduce its value. The central bank may also buy the foreign currency reserves so that the supply of foreign currency is reduced and the value of foreign currency is increased. Thereby, it has a negative impact on the domestic currency. Large scale intervention by the central bank in case of currency appreciation may prove to be very costly and it may not be a long term solution because it is always expensive for the central bank to intervene in case of currency appreciation. Now we come to central bank intervention in case of currency depreciation. The central bank may intervene if there is excessive currency depreciation. If the value of a currency of a country excessively depreciates, then the central bank may intervene to prevent that excessive depreciation or to stabilize the currency. The central bank may intervene to protect importers. When the currency of a country depreciates, it means that imports become costlier. So it import adversely affects those sectors where the goods are being imported from other countries or the raw material is being imported from other countries. So all the units, business units or industrial units which are importing goods from other country are adversely affected by currency depreciation, and there may be job losses in those units which are dependent on imports. To counter the effects of currency depreciation or to stabilize the currency, the central bank of the country may sell foreign reserves. When it sells foreign reserves, it buys its own domestic currency. When it buys domestic currency, it sends signal to the foreign investors that the government of the country sees some value in their currency, and it gives them positive signals, so the foreigners also become interested in their value in the domestic currency of that country. The central bank of that country may also raise the interest rates. When the interest rates are increased by the central bank, the foreign investors would like to make investment in that country, and the interest in the domestic currency increases, and it increases the value, or the depreciation of the currency starts not to further depreciate, or there is stabilization in the currency of that country. Large scale intervention in case of currency depreciation by the central bank may prove to be very expensive. Further, if the central bank chooses to sell the foreign exchange reserves to appreciate or to stabilize their currency, it may result in the depletion of foreign exchange reserves. Now, the topic before us is understanding currency erosion, devaluation versus depreciation. First difference we will understand on the point of definition. In case of devaluation, it is the deliberate or official reduction in the value of a currency relative to other currencies by the government or central bank. What it means? We are living in India, and approximately 83 Indian rupee are equal to 1 US dollar. If the government or the central bank of India decides to reduce the value of the Indian currency, then it is devaluation. Suppose it decides that from now onwards 90 Indian rupee will be equal to 1 US dollar. It is devaluation. This decrease in the value of Indian rupee vis-a-vis other foreign currencies by the government order or by the order of the central bank of the country is devaluation of the currency. Here, external forces such as demand and supply, etc., are not the reason for the reduction in the value of the currency. The value of a domestic currency has decreased only by government order. This is devaluation. Official order is there to reduce the value of a currency. On the other hand, if the value of a currency depreciates in comparison to other currencies by the forces of demand and supply, then it is depreciation of the currency, where the market forces of demand and supply come into picture and the value of a currency decreases, it is depreciation. Exchange rate system. Devaluation occurs under a fixed exchange rate system. Fixed exchange rate system means where exchange rates are predetermined and the government intervenes to maintain that rate. We take the example, suppose if the government of a country decides, suppose a European Union, we are taking the example simply, that if European Union decides that 1 euro should be equal to 1 US dollar and it should remain somewhat as it is, and to maintain that balance it will be taking steps that the one value of 1 euro remains equal to 1 US dollar. So this is the fixed exchange rate system. So typically occurs under this devaluation occurs under a fixed exchange rate system where the exchange rates are predetermined and the government intervenes to maintain that rate. Suppose if the value of euro increases and the European Union is following fixed exchange rate system, suppose here 0.9 euro becomes equal to 1 US dollar, the government of the country may reduce the value of its currency to ensure that it again becomes equal to 1 euro is equal to 1 US dollar. Then depreciation. Depreciation of the currency occurs under a floating exchange rate system. When the demand of the currency falls, when the demand of anything in the market decreases, what happens? The price of that goods decreases. In the same way, in the foreign exchange market, when the demand of a currency decreases, the price of that currency also decreases. So this is the depreciation, and it occurs under a floating exchange rate system. Now, what is the cause of devaluation? The cause of devaluation may be government policy decision. The government of the country may have decided that it wants to make exports cheaper and imports more expensive, so that it may improve the trade balance. On the other hand, depreciation of the currency may be caused by the change in supply and demand of the currency, domestic currency. There may be negative outlook, economic outlook of the country, economic performance of the country is not good. There is political instability in the country, and the speculative investors also believe that the value of the currency is likely to depreciate in the near future, so they will offload their domestic currency. So it will result into the depreciation of the currency. Speed. Devaluation is a one-time exercise. The government may have decided that it wants to reduce 10% reduction in the value of the currency. It is a one-time decision. The government of the country may decide any percentage, 1%, 2%, 3%. And this is a one-time devaluation of the currency, one-time reduction in the value of the currency. This action has immediate impact. If suppose at present 80 Indian rupee are equal to 1 US dollar, and if the government of India decides that it wants to devalue its currency by 10%, then what will happen? Immediately 88 Indian rupee will become equal to 1 US dollar. Impact is immediate on the exchange rate. However, in the case of currency depreciation, the depreciation of the currency can be gradual or rapid depending on the underlying market forces. The impact of depreciation might not be as dramatic and immediate as the government driven devaluation. It means that in the case of devaluation, there was immediate reduction in the value of the currency. That is, if the government decides at this point, there will be immediate reduction in the value of the currency. But in the case of depreciation, that depreciation, the value of the currency depreciates slowly and slowly, or it may be rapid, but not as fast as happens in the case of devaluation of the currency, because in case of devaluation it is by government order and it has immediate impact in the foreign exchange market. Now, appreciation of value. In the case of devaluation, it is possible for the government to raise the value of the currency after it has been devalued. It means that today the government decided to devalue its currency. Now, after some months, it decides to raise the value of its currency. It may do so. It may raise the value of the currency, but it is a very complex and challenging process to raise the value of the currency once it has been devalued. It, that is, if today 80 Indian rupee are equal to 1 US dollar and there was 10% reduction and 88 Indian rupee was equal to 1 US dollars. But after some months, the government decides to reinstate that original position. It wants to increase the value to 80 Indian rupee equal to 1 US dollar. It may not be as simple. The value of it is not possible to increase the value of the currency in one shot. The devalue is simple. To increase the value is not as simple. It is a challenging process. In the case of depreciation, once the currency has depreciated, it is possible that it may appreciate, but this is not a guarantee. If there is political instability in the country, the foreigners are not interested to make investment in the country, then what will happen? There will be no demand of the domestic currency in the foreign exchange market. However, if the demand of the currency increases, the outlook of the country improves, economic performance improves, the investors think that it will be worthwhile to make investment in the country, the demand of the domestic currency will increase and the value of the domestic currency will increase. Next is control. In the case of devaluation, government has direct control over the timing. It may decide that it will devalue its currency tomorrow or next week or on a particular date. The government decides what is the timing of devaluation and what is the extent of devaluation, whether it wants 1% reduction, 2%, 3%, the government decides timing and percentage of extent of reduction in the value of the currency. Government decides. But in the case of depreciation, it is the demand and supply in the foreign exchange market which decides the depreciation. For a larger market forces mostly dictate the pace and extent of depreciation. That is, the demand and supply mostly decides what will be the depreciation, whether it will be fast, gradual, or what will be the extent of reduction in the value of the currency. With the government having limited direct intervention, that is, in case of depreciation of currency, the government has very little intervention, direct intervention. Now we will take real life examples of currency devaluation and currency depreciation. Firstly, real life example of currency devaluation. Argentina was facing a very severe economic crisis between Argentina was facing severe economic crisis between 1998 to 2002. There was high inflation, economic performance of the country was not good, and Argentina was also following the fixed exchange rate system between their currency peso, PESO, and US dollar. Fixed exchange rate system was following. But in 2012, the Argentina government devalued its currency and it abandoned the policy of fixed exchange rate of peso versus US dollar, and it devalued its the value of its currency peso by about 70%. That is, the people or the residents of Argentina will have to pay more of their domestic currency to buy one US dollar. It was having very positive and negative impacts. Now, there were some short-term benefits of this devaluation. When the currency devalued, the exports became cheaper for the foreigners. So it helped the exports in increasing exports from Argentina. Domestic tourism thrived because the residents of Argentina were not in a position to afford outbound tourism. They were not in a position to make frequent traveling abroad because the foreign tourism had now become more costlier because the value of their currency has devalued. Now, the currency devaluation also had some long-term challenges. When the value of the currency has devalued, that is the value of peso, the currency of Argentina had devalued, the value of the currency had decreased by the government order. It reduced the purchasing power of the Argentina people. When the purchasing power decreased, it resulted into high inflation. There was social unrest. There were protests in the country. The debt burden of the country had also increased because the value of peso has decreased. So, if the Argentina government had taken the loan in foreign currencies, they will have to shell out more in their domestic currency to purchase the foreign currencies and to repay that debt. So, the currency devaluation is a double-edged sword. One side, it has some short-term benefits. On the other hand, it also poses certain negative impacts. So, any government should use currency devaluation with proper calculation and proper management. Now we will understand the example of currency depreciation, real life example. You have might heard about the Brexit vote 2016. UK was a part of European Union before this year. The UK government decided to have a referendum in 2016 to decide whether it should remain the part of European Union or should leave out of that European Union. The result of that Brexit vote was that 52% of the people, of the voters, decided or voted that they should leave European Union. About 48% of the people or the voters decided that they should remain in the European Union. That is, by a thin majority, the UK voters decided to leave the European Union. This is the Brexit vote. Due to this decision of the UK people that they should not remain in the European Union, they should not remain in the European Union, they should leave the European Union, the value of the British pound decreased. There was a very enormous single day fall when the result of Brexit vote was out and the value of British pound depreciated lot in the coming months also. Due to reduction in the value of domestic currency of UK, it make the imported goods more costlier for the British people. Why the currency depreciated? Because the investors or the general public abroad or the investors were worried about the economic position of the UK after leaving the European Union. What will be the economic position of UK in future when it will not remain the part of European Union? Whether it will be in a position to manage the international trade effectively, whether the economic performance of UK will be proper, what will be its economic relationship with the rest of the world and particularly the European Union. So when the UK decided to remain out of European Union, the value of its currency depreciated, and the process of depreciation of the currency of British pound continued for many months, and it increased the import value, or it makes the import of goods costlier for the UK people. There were also some industries in UK which were heavily dependent on the imported raw material. So it also increased the expenses or the production costs of those industries and reduced their profitability. So you have learnt from these examples that the currency devaluation and currency depreciation has their own impacts on consumers or the businesses as a whole. Now the topic before us is currency gains appreciation versus revaluation. Now first is, what is currency appreciation? Currency appreciation is the increase in the value of a currency relative to other currencies driven by market forces. Market forces means the demand and supply of the currency or other market conditions decide the value of the currency, and if there is increase in the value of the currency due to market forces, it is currency appreciation. But if there is a government order or the central bank order, and by that order the value of the currency increases, it is currency revaluation. It is the official increase in the value of the currency. Cause currency appreciation is due to the increased demand for the currency. If the foreign investors make demand for the currency of a country, it results into the increase in the value of the currency. It is currency appreciation. If the economic outlook of the country increases, the investors may decide to make investment in that country. Then the demand for that currency will increase, and it will result into the increase in the value of the currency. On the other hand, the government may decide to strengthen its currency. So it is the policy decision of the government which is behind the revaluation. In the case of revaluation, market forces do not come into play. Next is speed. In the case of currency appreciation, the speed of increase in the value of the currency may be slow or rapid depending on the market conditions, that is due to demand and supply or the economic outlook of the country. The appreciation in the value of the currency may be slow or rapid. But in the case of revaluation of currency, it is a one-time event. The government may decide that it is increasing the value of its currency by say 10%. It is a one-time event. The government has decided today, and it will have immediate impact on the exchange rate as has been decided by the government or the central bank of the country. Next is transparency. In the case of currency appreciation, market forces determine the exchange rate. That is, demand and supply determine mostly the exchange rate. So it is generally transparent. But in the case of revaluation of currency, the government or the central bank of the country publicly makes announcement about the exchange rate. Next is exchange rate system. Currency appreciation occurs in floating exchange rate system, and revaluation generally occurs in countries with fixed exchange rate system. That is, in those countries where the government is taking steps to maintain the fixed exchange rate between the currencies, between their domestic currency and the other currencies, then in those countries currency revaluation generally occurs. We have we are will be separately uploading the courses on the floating exchange rate, fixed exchange rate system in detail. You can also view the same. Next is control. In the case of currency appreciation, it is not directly controlled by government or the central bank of the country, because the market forces of demand and supply mostly decide the increase in the currency appreciation. How much increase should be there? It is decided by the market forces of demand and supply. But in the case of revaluation, the revaluation is controlled and implemented by government or central bank. That is, the central bank or the government makes announcement that this will be the revaluation of the currency. So it is controlled and implemented by the government and central bank. Now we will go through real life examples of currency appreciation and currency revaluation. Firstly, the real life example of currency appreciation. From around 2003 to 2008, Australia experienced significant currency appreciation. That is, the value of their currency appreciated in Australia. Why? Because there was high GDP growth, there was booming mining sector, and there were robust exports. That is, good exports, good in good quantity. The exports were there of coal and iron ore. It was having those reserves, and so it was exporting. Political environment in that country was very stable. The interest rate policy of the Australian central bank was also very favorable. So all it resulted into the appreciation of the currency of Australia during the period 2003 to 2008. Now we will understand the case of currency revaluation of China's yuan currency. China's yuan currency from 2005 to 2010. Prior to 2005, the China was adopting the policy of fixed exchange rate system of its currency vis-a-vis the US currency. That is, it used to peg its currency, that is yuan, with respect to US dollar. That is, it was taking steps to ensure that the value of its currency remains stable with respect to US dollar. Then, facing the pressure from US and other trading countries, because the China was having a very big trade surplus. So, facing pressure from US and other trading partners, the China government in 2005 abandoned the policy of fixing its abandoned the policy of pegging its yuan against US dollar. So when it's abandoned the policy of pegging yuan against US dollar, then the currency of its China revalued. Initially, it was around 2.1% when it initially increased the value of its currency, and between 2005 and 2010 the currency was revalued many times by the Chinese government, and during the whole period of this 2005 to 2010, about 30% appreciation in the value of currency of China was there. Approximately 30% increase in the value of yuan was there. When the value of its currency has increased, it had its own impacts. It reduced the trade surplus with respect to several countries. That is, it was China was exporting in large number to certain countries and importing less. So it reduced the trade surplus position with respect to many countries. It also increased the imports because the cheaper imports helped Chinese people to control inflation, and it also improved the standard of living of Chinese. Increased imports. Exports were adversely affected in case of currency evaluation by China because the exports became costlier for the foreigners, and those industries which were exporting goods to, in other words, the export oriented units were badly affected, and there were job losses also in export oriented sectors. Then there was also pressure on the exporters to improve their performance and to concentrate on innovation so that they can remain competitive in the market. So we have understood the real life examples of currency appreciation and currency revaluation. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.